Welcome everyone to this Friday, June the 19th edition of Frontier Opening Bell. I am Bosin Ofaye. Welcome everyone to the show. Let me bring on our panelists for today. Uche Namenis, we're going to start from you as a managing partner and FX trader at Blue FX Nigeria. Thank you, Uche. We appreciate your coming through on the program today.
Thank you for having me, Bosin.
Good morning. And Ayode Jiebro, who is the CEO and a chartered trader at Afinvest Securities and Investment Firm. Thank you very much. Also here in Lagos. Morning. Thank you, Ayo. And of course, Ali Khan Sachu, the CEO and founder of Rich Frontiers and Rich TV Africa. Thank you so much, Ali. We appreciate you joining us this Friday. Let's go TGIF if we can.
Oh, great. Thank you.
Okay, great. So let's go just quickly about a minute over Africa's some of Africa's equity market indices for Thursday. A bit of a trending along with the rest of the global space on Thursday. Nigeria's stock market down 0.16%. The Ivorian market, that's the BRVM, just about 0.1% in the green territory. The Egyptian market, that's the EGX 30, 0.44% in negative territory. The Kenyan market, that's the Nairobi Securities Exchange, was just about flat around 0.01%, 144.92 reading. The South African market lost 0.16%, lost to 54,000 reading, where it finished off on Wednesday. So let's look at the East African markets where Ali is seated. Let's see where the Nairobi market, a lot of stories around the Kenya Central Bank doing massive, fast and furious treasury sales, yields going down fast. Like other central banks across Africa, Kenya is doing treasury sales, Nigeria is doing bonds. Meantime, the Nairobi Securities Exchange is planning its annual shareholders meeting for July the 9th to approve a final dividend of 0.08 Kenya shillings. In the meantime, the central bank in Kenya got about 2.12 billion shillings in dividend earnings. That's from the KCB, that's Kenya Commercial Bank, pardon. And the Treasury's got about 2.12 billion shillings in dividend from Kenya Commercial Bank. That's the government. There. Meantime, Rwanda will see a slightly wider deficit, according to Moody's. So let's just throw this. Let me throw this straight to Ali to flesh it up for us.
So first of all, as you mentioned, there's been huge demand for treasury bills and treasury bonds being sold by the government of Kenya. Oversubscription rates have been around 250 to 350%. Very similar phenomenon to what you're seeing in Nigeria and some other African countries. And what it is, it's actually a very positive sign given the amount that Kenya will need to borrow in the next full year. And it speaks to a number of things. It speaks to a collapse in private sector credit growth, which has left a big liquidity buildup in the banks. We also had a relaxation in the CRR rate, which released more money into the system. And it's a combination of that plus an interesting yield curve where basically you're getting up to 450 basis points of carry if you're going out to 5 or 10 years. And that total mixture has created this very bullish development in the local bond market, which I'm sure the government of Kenya are extremely grateful for. And as you previously said and discussed, it's a phenomenon you're seeing across on the West Coast as well. With respect to Kenya Commercial Bank paying this very handsome, juicy dividend, it's worth contextualizing in the sense that Standard Chartered, after announcing a very big dividend, halved the payment. A number of banks skipped a dividend payment. Equity Bank, which is is our second biggest bank here, announced a dividend and then said, no, we prefer to conserve the cash. So, firstly, the government of Kenya is a big stakeholder in KCB, not as big as it was, around 15%. So it's a very valuable dividend for them and for their cash flow. And it will be interesting to see, what happens with KCB over the rest of the year. They restructured about $1.2 billion of existing loans, which is pretty huge when you think about it. Rwanda, Moody's seeing a wider fiscal deficit. I think we all saw that. Rwanda has had probably the most aggressive lockdown and has had the least number of fatalities from the COVID-19. And the World Bank and the IMF have been supporting Rwanda. So I think that was within expectations. So overall, I think the really big story is this liquidity surge we're seeing out of the banks, snapping up government paper, which is giving a sense of relief all round for now.
Okay, great one there, Ali. Let's continue on the trajectory of bonds and treasury sales by African sovereigns with Ayodeji Ebo at Afrinvest. Ayodeji, I'm sure everyone's read up the Bloomberg story about Nigeria being the poster boy for bond sales in SSA, but that is not just about Nigeria. Togo is doing the same thing, looking for doing the second a global debt offering. Moody's Investor Services says that would not be enough. That would not be a silver lining or silver bullet for these small West African states. Meantime, the Central Bank of Nigeria is thinking about non-interest framework for all its interventions in agriculture. At the same time, in corporate news, Seplat formally announced the ceding or the transfer of his OML 438 and 41 to his subsidiary, Seplat West Limited. Says there will be no negative impact on its ratings or the tax revenue to the Nigerian authorities or his debt. So says everything is fine. Deep Capital Management is one very investment firm that is seemed to be in troubled waters over some time. So an emergency meeting was done yesterday, Thursday, over the state of the company relationship in relation to AMCON, which is Asset Management Corporation of Nigeria, the SEC, the Nigerian Stock Exchange, the conversion plan for debt and equity, its annual shareholders meeting, including the one for 2018 earnings and all of that. So coming here, let's talk to us about Nigerian markets, the treasuries and treasury bond side. Ayo.
Yes, it's been interesting times. On the back of COVID-19, we've seen for most African countries, most of them depend solely on commodities to finance their budgets. And we can see what the pandemic has caused. There's been significant contraction in revenue. So on the back of that, we are seeing increasing interest in the raising of debt from the government. And you are right that it's just a drop in the ocean. It's when you look at even the planned fundraising rather by the government, even for Nigeria, is relatively small compared to what the budget deficit is. So we feel that for most of the African countries, what they need to do, borrowing a leaf from Egypt, is to see how they can create an enabling environment that will attract foreign investors. They don't have to raise all these funds to embark on all these projects. They can partner, but before they can get those potential investors, they need to create an enabling environment that would ensure that that will provide confidence for them.
So Ayo, quick one. So we've seen yields are coming down, trending lower in the Nigerian space. The Treasury bills, which was done by the Kenya Central Bank yesterday, yields also keep tumbling. So do you think these Africas, including Nigeria, is still attractive despite this low level of yields being offered to investors by the various central banks?
especially for investors. And one major factor driving yields down is based on available liquidity. So, in terms of available investments, there are no major alternatives. Yes, we've seen people coming up with structured products, but we know that there are always inherent risks. There are structured products around the agri within the agri space, within the real estate sector. But when you also do your analysis, you would see that when you compare what they are also raising relative to the amount of liquidity in the system, this year we are still expecting about 6 trillion worth of OMO maturities that would in the system. And when you compare that to what government will also be raising, so the sustained decline in rates that we are seeing and investors feel comfortable to invest in it is as a result of the liquidity and little alternative. Whatever any investment that will be above that, it means that there's the element of risk. And most investors, especially for the fund managers who are saddled with responsibility of keeping investors' funds, the kind of risk they also take is minimized because whatever happens also falls back to the fund manager and the company that is holding the funds on behalf of clients. So I believe that rates will remain still very low on the back of liquidity. But once we begin to get more structured investment with less risk, then we'll begin to see less pressure on the sovereign.
Okay, great, Ayo. Later, before we wrap up the show, we want about a minute or so from you, your thoughts about the Central Bank of Nigeria looking at non-interest framework for interventions in agriculture. Nearly $500 billion and $500 billion naira yesterday was announced as new interventions for the 2020 planting season. But quickly look at the global space, which in a minute for us. The South African rand is making a bit of a little bit of a soft comeback this morning after a negative finishing on Thursday. The GSE also opened positive this morning. The global market looks to be on a good footing. Crude oil, Brent at 42 this morning, 42.16, gone up to 42.33. The WTI is looking at about almost $40, about 39. About $39 a barrel. So give us your take here on the global space. Then Ali will weigh in a little bit more on South Africa's central bank's Lesege's Thursday lecture.
Right. So what we can see now is a bit of risk on sentiment in the global space. And that is what we're seeing in the South African rand. We can see oil prices appreciating on the back of that. And we can also see risky assets also looking to appreciate. There is this, should I say, investor vibe that we are at that place whereby we are bottomed out in March and we cannot get any worse. We can only get better. Economies are starting to reopen in some way. There is a risk of a coronavirus, but however, as it is, it's going to always. It is now being sort of being described like that water under the bridge. It's not. We are not having that coronavirus as a thing that would sort of shake the market in the way it did a couple of months back. It has come to stay, at least in the near term, medium term, until we have a vaccine. So we'll continue to just play around it, and investors having that concept will give them the opportunity to take yields. I need to mention something when it comes to yields falling in Nigeria and other emerging market space. If you look at our local space, you realize that there are really not much diversified product, as Ayodeji has mentioned. And really, what investors would like to do is still go to the place they consider their funds as safe. So what we are seeing are investors looking to make their money work for them, and the best available viable investment vehicle right now are basically the fixed income space, and that's why we are seeing the yields drop in that way. Well, for me, I know I come off as a contrarian, but I still feel that we are getting ahead of ourselves. There is still so much risk, and with the way things are now really upper overvalued, if I want to use the combination of those words, is if we get anything, any sort of trigger right now, like what we saw with the COVID-19, it's not going to be, we will not be talking of having consecutive recession now. We'll be thinking of how we want to mitigate a depressionary risk, basically. And that is where I think we investors should really apply caution going forward.
Okay, apply caution. So if you look at the word caution, Ali, was that your reading of SARB, the Reserve Bank in South Africa's governor, Leseja, yesterday's lengthy speech about the economy and where things will go? He says it's inflationary and not in the best interest of South Africa or any African market or economies to go the way of bond buying like the folks in Europe and in the US. He also said that the output in the South African economy will contract by 7%, repo rate 275 basis points, and all of that. So, meantime, new government bonds in South Africa is about 25 billion rands.
So I listened carefully to what the governor was saying, and he, of course, the big comment that I took away from it was he was not going to enter into this quantitative easing cycle, what I call magic money, hocus pocus monetary policy, which you can do, like he said, if you're in the developed world, but it's much more difficult for us here on the frontier to do that, simply because our currencies are not widely traded, and I think, you know, the backlash from doing that would be quite expensive. So I agree with what he said. I thought he painted a very clear picture. 7% contraction, that's about right. Banks are talking about a 10% NPL ratio being the most likely. So when I took what he said in the mix, I thought he gave a very responsible perspective on South African markets. And just to tail back to what Uchenna was saying, you know, I think the markets are now very overpriced. I was looking at, for example, the PE ratio on the S&P is the most expensive it's been since the dot-com crash, right? So we're now looking at a nearly perfect scenario, V-shaped rebound. That's what the equity markets are pricing in the Western world. And I think it's been a liquidity surge that's sent all these risk assets into orbit. And the question is, it's all very well riding a tiger, but the lesson is you've got to get off, you know, at the right time. And I would just sort of say that to investors. And the final point about this huge demand we're seeing in our local markets for bonds that we're seeing in Nigeria and we're seeing in Kenya. The point to make is foreign investor participation is at zero unless they are trapped, right? You're not seeing external investors say, wow, I want to buy these bonds. Not to be seen. They're only buying it if they're stuck, they can't get out, and they need something, some kind of return. So I think our central bankers have been rather cunning and clever. But at the end of the day, one's got to ask ourselves, you know, is it real? It is real because the domestics have taken it up, but it's going to require a lot of manipulation and massaging to maintain it.
Because you see, everyone left, right, and center, Ali, Burkina Faso, Ivory Coast, Togo, and you know that Nigeria has a backlog of queues of foreign investors who are waiting to get out of the system. There's dollar illiquidity. So, like you said, they are trapped in the inside. Make the best of the bad situation or where you found yourself. That looks like the name of the game.
That's right. I think you've characterized it exactly correctly, right? This is, so we're not seeing, you know, people aren't going, wow, Nigerian credit at whatever, local interest rates are 4%, trade of the century. Kenyan interest rates at 11 or 12%, trade of the century. No one is saying that. It's more a situation which has been created domestically by releasing cash into the system and by creating a steeper yield curve, which has created this out and a collapse in private sector credit. you've got to remember the private sector, typically is the engine of the economy, and these guys are stuck in first gear in most cases.
It's okay, guys. Take a ringside seat, have a cup of coffee. We're going to try to sort everyone out. That's what is going on. Okay, great. So Ayodeji, let's give us a minute of your thoughts about Nigeria Central Bank announcement on Thursday about this non-interest mechanism for its interventions in agriculture. You think this is a new way of trying to get to ramp up in agriculture, try to help the sector get out of the COVID problem, try to tackle food inflation, get more money to the hands of farmers and others within the value chain?
The intervention funds that we've been seeing, especially the Anchor Borrowers Program, we feel that, my view, that we need to see like an impact assessment to see how those loans are actually translated into improvement in agri. Just to provide some form of transparency, where we are not questioning the action of the CBN on that, but it will also help shape perspective. So the non-interest banking is just another dimension of funding. But something interesting about the non-banking is that they share the risk, so you don't pay interest. So if you have your farm, it's based on the profits that you make that will be shared. So not like you'll be paying interest on the fund that will be advanced to you. So they share the risk, which is like a partnership arrangement. That's what you get for non-interest. So it's good to have several dimensions to hit, but it's also good to have some form of assessment to see how it's been yielding results, so that we know if we need to double efforts on that.
Well, quite a number of analysts and others have tried to assess this, and perhaps the central bank is listening to the repayment process for the previous interventions. Perhaps they've seen some loopholes and decided to apply the non-interest, because that will work for most of the part of where the intervention is taking place, in which farmers perhaps are not pressured to look at repayment, but it's a partnership. So we're just going to, whatever comes to the table is what we share. Perhaps that's going to be much better than trying to say, look, you take this from the central bank, it's coming at 9% or 5%. So when folks think about interest rates, the first thing is that the mind goes, how do I pay the principal and the interest on it? So maybe non-interest framework will be better. We don't have the details yet, but we'll try to get that over the weekend. And on Monday, I think we'll be able to communicate back to everyone. So let's talk about a little bit about the North African market. I want Uchenna to come in within this space. If we look at the Morocco, which is one of the largest economies north of the continent, the central bank is expecting the economy to contract about 5.2% in 2020. We've seen a raft of what you call contraction expectations and outlook from a number of African countries and economies and markets. So Tunisia, the minister in charge of the investment, says Tunisia will contract by about 7% as well on the pandemic. So what are your thoughts around how economies can leverage whatever is on the ground to get some dollar inflows, try to get everything running, taking a bit of a help or whatever, right on the back of what we're seeing in other developed economies?
I think I think basically what countries should look to do, or already doing, or probably just increase the intensity, is more like having an effective combination of fiscal and monetary policies. I know central banks are continuing to ease monetary conditions in their respective economies, but there's always that issue of how much the government can spend, how much they can actually stimulate from a fiscal point of view. And that's what economies are starting to look at right now. We can take a cue from the Federal Reserve that sort of reached out to the federal, the US government, saying that, well, we need that infrastructure spending. There is so much we can really print, and that would may not exactly translate into the real economy. And that's really what we're seeing, because really the financial market is not directly the real economy. And we are seeing that divergence in terms of what is happening in equity prices and macroeconomic data. So yes, I think it's very important for governments to really, governmental bodies to really step in to provide that physical, should I say, structure to help the economies sort of rebound in the nearest time or fastest way possible. It's clear that right now everybody has taken the heat and understood that we're not looking to get anything so tangibly optimistic as regards to 2020. We're just looking to ride the wave, sort of mitigate and sort of just amend deficits and gaps as to macroeconomic condition. What we really want to focus on is the fiscal year 2021, and that's what a lot of analysts are looking to point out to, really.
Interesting. For next week, thank you, gentlemen. For next week, Africa's debt will be in sharp focus. For us, we're looking at a webinar on a conference on Wednesday at about 12 o'clock UK time to take a very deep look at Africa's debt, whether to forgive or forget or whatever. So that's got a big one next week. We want you guys to be on the lookout for it on our social media and all of that. It's going to be a big one. So thank you, gentlemen, for being part of the program this Friday, the 19th of June. Ali Kansachu, Rich Frontier CEO and founder in Nairobi. Thank you. Have a great weekend. Ayode Chiebo from Afrinvest Securities, the CEO. Thank you very much. And Uchenna Miris, thank you very much, from Blue FX, the managing partner, Blue FX Nigeria. Thank you, gentlemen. Have a great weekend. I will see you bright and early on Monday.